Welcome back to the deliberations of CNBC-TV18's Citizens Monetary Policy Committee. We have with us Samiran Chakrabarti of Citi, Sonal Verma of Nomura, Soumyakanti Ghosh of SBI, Sajid Chinoy of JP Morgan, and our chairman, Dr. Pranab Sen. It's time now we discussed what the MPC should do. So, Sajid, you tell us first, is there space for one cut, two cuts, by which I mean 50 basis already on April 4th, and what should we expect on liquidity?
Sada, I think the MPC made clear that the focus of monetary policy will be to be consistent with the legislated mandate, which is that if inflation is below 4%, then the MPC has some space to ease monetary policy. And what we're seeing is that there's this huge divergence between food inflation and core inflation, and that divergence continues to sustain. In the latest print, core inflation actually accelerated to almost 6%, it's 5.9, but food inflation remains very benign. That said, over the next 6 months, we think inflation at a headline level remains very benign. Our average inflation forecast is for the next 6 months just about 3%. So to the extent that that is the outlook and the MPC is focused on the headline target, I think there is perhaps space for one more cut, and so we expect the MPC will cut rates in April. However, as we've mentioned in the past, we continue to believe that over time it is headline that gradually gravitates towards core and not the other way around. So I'm not sure there's space for a large easing cycle here, probably a cut in April. Also, inflation expectations have been quite sticky in this range of 7 to 9 for the last 3 or 4 years. So we believe, yes, there is space for one cut in April.
Okay. Soumya, if you can continue with this argument, what should the Reserve Bank do on rates? And rates looks inadequate now because the previous one hardly got passed on, rate cut. So, therefore, the question to you is, what should they do on rates and, more importantly, on liquidity?
Yeah, I mean, the problem is that, and you asked me before about the real rates, and the challenge is about ex-ante real rates versus ex-post real rates. So, if we are projecting inflation at 4% plus 12 months ahead, then your ex-ante real rate is reasonable. But since we are constantly almost achieving the actual outcome at much lower than what the projected inflation is, the ex-post real rate is turning out to be much, much higher. And that's something which the MPC needs to think about, that whether we can operate with as long as a 12-month horizon on inflation forecast, or we should be looking at some kind of putting more weightage to near-term forecast and less weight towards the longer-term forecast. So that sort of a thing could drive a bit more dovishness into the MPC thought process. But the transmission bit, to be honest, it's not really MPC's core mandate. It's more lies with RBI about what kind of instruments that can be used. I don't think the April policy will give you any clear indication of a OMO calendar for April, May, or even some idea about how many more FX swaps are going to come, because this is going to be a tricky couple of months of liquidity because of the election-related oddness that it introduced into the liquidity assessment. So
I don't want you to get bogged down only by what is the MPC's mandate. Basically, if you think the economy is weak and rate cuts are not helping, should we go a little more all out on liquidity?
Absolutely. So if you look at a slightly broader picture, the fact remains that we are targeting kind of a fiscal number which is lower than last year, the fiscal deficit. So there's no question of a fiscal stimulus. So if growth is weak and it needs a bit of support from policy, that has to come from the monetary policy side. And because inflation is relatively low, you have an option of easing somewhat. And then it comes to how do you pass on that rate cut onto lower lending and deposit rate. In my view, that can only happen if you are proactively committing towards keeping liquidity ample in the system. Now, how do you do it? You can do it through a calendar, you can do it through proper guidance, but that bit needs to be communicated better. The market still seems to believe that RBI is keeping liquidity a little tighter.
Okay.
That's the belief in the market. And it's all about how you communicate here, because this forward guidance is very important on liquidity for rates to actually pass on, because we have a structural problem, let's not forget about it, which is about a saving investment imbalance and crowding out. So those things are there at the back. I'm not ignoring that. So if you have those problems, then how do you transmit relatively easier monetary policy onto lower lending and deposit rates?
Unfortunately, you're running out of time. Sonal, the question I'm trying to get at is, should reverse repo become the guiding force? I mean, should RBI move to surplus liquidity? As a Monetary Policy Committee member, what would you do?
At this stage, I think we shouldn't. But the point is that transmission will happen. Transmission usually takes multiple quarters to happen, so it will happen. Currency leakage has partly been high because of the elections, so post-elections currency leakage should come down. And if growth is slowing down, you should also expect the incremental credit accretion going forward to be less than what it has been in the past. So the incremental credit deposit ratios will also ease. So things might look extremely tight right now, but I do think over a period of time, given the macro dynamics we are considering, given post-elections, I do think transmission will happen, but slowly. My concern, Lata, is that I think we're seeing a very, very segmented economy, that the entire transmission is only happening largely in the consumer space. And like I said, the divergence between haves and the have-nots, especially the sectors that really need money, I think that's becoming extremely wide, and that's my bigger concern.
Yes, there is a trust deficit with respect to several NBFCs. I take your point. But, okay, let me get to Soumya. Do you think the policy stance should change? I mean, even if the RBI doesn't make reverse repo the, guiding force, put so much liquidity, should it, change its language to accommodative from neutral?
Yes, I think before I answer, I'll just take 10 seconds to, to address one of the concerns of the liquidity framework. I think there the market needs to be communicated better, because you can't have a repo and then CD spread which is close to 200 basis points when the liquidity framework is actually supposed to be neutral. And the problem which Sajid says is that now frictional liquidity is substituting durable liquidity injection. So that is one point, because durable
we have done a lot of durable liquidity.
Yes, but the durable liquidity outflows this year has been around 5 trillion, including that because of the global market, external market turbulence, to be fair to them, 5 trillion, but the RBI has done OMO up to 3 trillion. So they have done enough OMO, but the withdrawal has been so much that there has been some element of substitution. Now, having said that, in terms of the stance, I think yes, given the current growth condition, given the fact that growth is going to remain weak for the next couple of quarters, I think you need to cut rates, given that you have to do the policy heavy lifting to the monetary policy, and possibly one rate cut will not suffice. Possibly a larger rate cut will suffice, but the issue is that whether you need to cut at a larger rate, more than 25 at one go, or you want to spread it over. In any way, even if you want to cut it by, say, a larger than 25 basis point, you need to change your stance. Or even if you want to cut by 25 basis point, you have to give a clear signal to the market that we are here for a dovish policy. So in that case also, I think there is a strong case for changing the stance from neutral to accommodative.
Okay, very quickly, Sonal, do you want reverse repo to be the signaling rate? No.
Not yet, Lata. I think definitely the liquidity deficit needs to be close to zero. So the spread shouldn't be substantial. So that is a precondition to ensuring that transmission happens in a rate cutting cycle. I think the fact that transmission takes time, is a fact, and therefore, while transmission may not have happened as much, I'm just making the point that if you keep liquidity around neutral, the transmission will happen over a period of time, and the currency leakage, if it does come down, that will also ensure better transmission.
I'm getting a sense that Sajid, Sonal, and Samiran are not going for as much of loose liquidity as perhaps Soumya is arguing. Well, Dr. Sen, the last word, sir. What should the Reserve Bank do in terms of rate action, in terms of liquidity? And you were the one who is warning about overkill.
Yeah, my sense is that the RBI will need to actually, and this is a timing issue rather than what should be done. I think liquidity has to be increased. Rates will eventually have to be cut. The question is, which do you do first, which do you do second, do you do both simultaneously? This is a strategic issue. My own personal view on this is that RBI is going to be focusing on the liquidity side for the time being, and they will worry about rate cuts a little later. The rate instrument, I think, will be something that will come post-elections. That's my personal view.
Okay. All right. Gentlemen, you have put, I think, all the relevant factors on the table. It's time you take up your pens and vote. The first question I'm going to ask all of you is, what rate action should the Reserve Bank cut or stay pause? And if it cuts, how much? So first, that question to you, Sajid, cut or pause, and if it's a cut, how much?
25 basis point cut in our view.
Okay. All right. Okay. We need to see your board as well. Samiran, what are you expecting?
25 basis
25 basis rate cut. Okay. Sonal?
Yeah, 25 basis point rate cut.
Okay. Fine. Shaumya, what are you expecting?
We're expecting a 25
basis cut. Okay. Chairman, sir, would you disagree?
Yes, I would.
Yes. Okay, well, the chairman has a reputation of calling the market, calling the MPC right in the past, even when he is in a minority. Now I want to know about the stance. Sajid, at the moment it's a neutral stance. What would you want? Some people are asking for accommodative. What is your expectation of MPC stance?
We think that the neutral stance, which gives the RBI to be very flexible in all directions, is appropriate.
Okay. Neutral stance, what's your...
it's a maybe from me.
Okay.
There is a possibility.
You mean maybe they will change
Maybe they will change it.
Okay. I mean, I would really wish if you vote one way or the other, but Sonal, is it going to be neutral? Is it accommodative?
I think they will keep the stance at neutral.
Neutral-ish. So you also like kind of not very sure. Shaumya?
Yeah, I believe there is a possibility of a rate stance to accommodative.
Okay, okay. Accommodative. So actually, a lot of you are veering that the neutral stance may change. Dr. Sen, should the stance change? Neutral. Well, the chairman is very clear that we shouldn't go for overkill just yet. Let me see if I can squeeze in a third question. Sajid, how many rate cuts are you expecting through 2019, counting April? 25, 50, 75?
Yes, including April, it would be 25, at most 50 basis points.
Okay. Well, Samiran?
It's 50.
50 basis. So April and one more cut. Sonal?
Yeah, 50 basis points.
50 and one more cut in the future. Shaumya?
50 BPS, but with a possibility of an upward bias if growth doesn't pick up.
But you are expecting the 50 to come on April itself?
That will depend on the rate stance.
Okay.
So that's then.
Dr. Sen, how much of a rate, how many basis points will rates fall in 2019? 50 basis. Okay, there is unanimity over here that a half a percentage point rate cut through 2019. Only on April 4th itself, 4:1, the expectation is of a 25 basis cut. A little undecided as far as the stance is concerned. Many people expecting, I mean, that it could become accommodative. Chairman, Dr. Sen and members of the Monetary Policy Committee, thank you very much for an extremely enlightening and enriching discussion.